Bet on anything markets have just had their best years ever. These platforms let you trade on everything from elections to the numbers of starving children in active war zones, all the way down to Jake Paul getting the snot beat out of him. Now, as a shock to absolutely nobody, the proliferation of these markets is already having some questionable impacts on the state of our society. But that's easy to ignore when these platforms are bringing in this much money. Just Kalshi and Polymarket, the two largest prediction markets right now, are on track to handle over $100 billion in trading volume this year alone. And other businesses have noticed this. The mass adoption of betting on everything has become so widespread that it's threatening the thinly veiled gambling facilitated by platforms like Robinhood and Coinbase. So, they are just starting their own prediction markets as well. Within just the last year, no less than 12 major organizations including CME Group, Sports Illustrated, and Trump Media's True Social have launched or co-hosted their own prediction markets, so that no matter what platform you happen to be using, you can conveniently bet your rent money on whether aliens will be confirmed before GTA 6 is released. Like a lot of modern financial developments, it would almost be funny if it wasn't going to have such devastating consequences on average people. But hopefully by now, you already knew all of this. What most people haven't noticed so far, though, is the businesses that stand to make the most money out of all of this. And spoiler alert, it's not the market facilitators themselves.
People who think they're going to win and literally lose all their money and end up driving Uber.
Going to use prediction markets to figure out what's actually happening in the world.
You should gamble on esports, on video game items, on slots with those items.
Financial market that prices questions about the future.
So now I'm here doing Uber Eats on a daily, sleeping in my car. So please, don't gamble, guys. Trust me.
Okay, so as a bit of technical housekeeping, it's important to understand the mechanical differences between modern prediction markets and more traditional bookmakers. A traditional bookie or sports gambling operator like DraftKings or FanDuel effectively makes bets directly against their clients. If you bet on Ohio State to beat Michigan, the company themselves needs to pay you if Ohio State does indeed win. Now, normally, they are going to give you worse odds than the true expected value of that bet, which is how they make their money. If the game is a true 50-50 toss-up, then they might only pay out $1.95 for every dollar that bets correctly. Now, the term bookmaker actually means that for them to operate consistently, they should build a book of bets for both sides on this game so that no matter which team actually wins, the losing bets pay for the winning bets and they get to keep a nice little margin either way. Filling up a book of perfectly weighted bets is actually quite challenging. If too many people bet on one particular team, then that leaves a bookmaker exposed to a potential loss if that team wins. So to counteract this, they will try to get more people to bet on the opposing side by offering better odds to them and worse odds on the team that already has lots of people betting on it. In the past, this would be done by human traders sitting at a desk that looked like a regular stock trader's desk in a hedge fund. But today, most platforms like this use sophisticated algorithms to manage all of the thousands of individual games they take bets on. Prediction markets like Kalshi, Polymarket, and the dozens of copycats that are trying to cash in on this degeneracy are slightly different. They never directly take on the bets themselves. They just offer a marketplace where people can come together and trade on their disagreements. You might log into one of these platforms and offer 20-to-1 odds on HREOC reacting to this video, but the platform itself doesn't take you up on that bet. It just posts it until someone else comes along and agrees to bet against you. It varies slightly from each one of these businesses, but they then normally take a small fee of around 1% off payout from whoever wins. Now, this slightly different model of just facilitating bets rather than directly taking them has allowed them to do a few things. The first is skirting around regulations. Since they are technically just facilitating trades between two separate parties who are agreeing on a financial contract, they are regulated by the Commodity Futures Trading Commission, assuming they are regulated at all. These bets are classified as just buying financial derivatives, so the regulations and even age limits are not as high as if they were overseen by a state gaming board. CoffeeZilla has done a series of great videos on the absurdity of how these platforms get around laws that should obviously affect them. So I will leave a link to that below if you haven't already seen them already, because I'm sure at this point, with the amount of gambling or gambling adjacent ads you have had blasted into your prefrontal cortex, none of this is all that surprising to you anymore. But the slightly less obvious thing that the business model of the bet on everything platforms has allowed them to do is to open up their backdoor to hedge funds who can turn this whole thing into their own protected hunting range. And it should probably go without saying, but you are the prey. So it's time to learn how money works to find out how the real money behind these platforms is really getting made. This video is sponsored by Odoo. Odoo is a complete business management platform that brings sales, CRM, accounting, inventory, manufacturing, and a ton of other tools inside one connected system. What stands out is how easily everything works together. You pick the apps you want, and they sync right away. The CRM gives you predictive lead scoring, the inventory and manufacturing tools track everything in real time, and the whole setup keeps your operations aligned without feeling overwhelming. We have been using Odoo ourselves for both Compounded Daily and the How Many Works library, and it has simplified a lot. Instead of juggling different services, all our subscriber management, content updates, and workflow tasks sit in one dashboard, which makes the day-to-day so much smoother. It is also very easy to learn. Setting invoices, planning production, checking inventory, starting new projects, customizing the interface, all of it feels straightforward and organized. If you want to see how Odoo can streamline your own business, use the link in the description to try it with a 15-day free trial, or keep any single app free for life with no credit card required. One of the other less obvious benefits to the prediction market business model is that since these businesses don't take on any of the bets themselves, the amount of money they need to start these businesses is far lower. Even under the most accommodating state gaming boards, regular casinos or bookmakers are legally required to have enough cash in reserve to cover all bets and cash withdrawals at any given time. For big operations, this can be billions of dollars, which is a significant barrier to entry for any startup that wants to disrupt the prediction market. The prediction market model means that people are betting against each other, which means the business itself can directly be liable for any payouts. Now, this has made it a lot easier for every app on your phone to launch their own micro casino, but it does present another problem. For people to trade predictions, they need someone to trade against. And nobody is going to put up money on a platform to trade against someone else if there is nobody there in the first place. Even the big established incumbents often struggle for liquidity across the thousands of potential markets they host every single day. So the solution is a market maker. In regular investment markets, a market maker will offer to both sell and buy a given security at a slightly offset price to make a little bit of money on the spread. They are essentially scalping cash off regular investors, but they are still seen as a welcome participant in the process because it means if you ever want to buy or sell a stock, you will almost always have a buyer or a seller there to instantly buy or sell to. In the most basic terms, they are the people that stand around in the grand exchange all day flipping items for a small markup. In real financial markets, this job is a little bit more complicated, because they are not only offering bids and offers for regular stocks, but also to a wide array of derivatives like options and futures that can change very quickly and unpredictably. Today, firms like Citadel Securities and Jane Street derive a large portion of their revenue from market making, and the significant rise in, let's call it, undisciplined retail speculation has been one of their all-time biggest opportunities. Highly risky financial instruments like zero-data expiry option contracts can generate huge returns, but they also present enormous risk. Making a market for these kinds of financial derivatives has allowed the quantitative analysts at these firms to systematically extract value out of people who are effectively just gambling. The more reckless their counterparty is, the easier it is for their algorithms to create markets where if it's heads, they win, and if it's tails, they also win. Prediction markets take the reckless behavior of these retail traders and completely get rid of the pretense that this is even in any way something that could be considered investing. Unsurprisingly, major hedge funds have jumped in to serve these markets. In their extensive advertising, companies like Kalshi and Polymarket would love to make you think that you are betting against some other Joe Sixpack who just happens to have a different opinion to you. In reality, and in the best case scenario, you're betting against this guy. Or more often than not, you're trading against someone with inside information. Now, at the moment, these platforms are actually so desperate to scale as quickly as possible that behind the scenes, they are offering direct incentives to firms who can provide them with liquidity in as many markets as possible. Other prediction market facilitators like Crypto.com have taken it one step further and set up internal market-making teams to trade directly against their own customers, which might make you think, hang on, doesn't that mean they have gone all the way back around and become a bookmaker again? The business's official answer to that question is, don't worry about it. It's not great, but it gets worse. Around 5 years ago, you may have remembered the controversy surrounding the practice of payment for order flow. A firm like a big hedge fund would pay a broker like Robinhood a fee, and in return, they would get to be the first in line to facilitate any customer trades if and when they were made. The same kind of process doesn't directly translate to these markets, but the preferential treatment can and does. All of these exchanges have back-end trading interfaces with a range of features that are not available to regular users, like broad market data, low latency connectivity, bulk order management, drop copy, and IP whitelisting. Naturally, these programs are only available to institutional partners, although you are technically welcome to ask for access to them. In regular investment market exchanges like the Nasdaq and the New York Stock Exchange, they have actually tried really hard to curb the advantages that big hedge funds can gain through tricks like high-frequency trading and dark pool market making. They have done this because if a market becomes too unfair, then regular investors are not going to participate in it. These prediction exchanges have gone the opposite way though, and have basically created a perfect playground for sophisticated market makers to profit off regular traders. Now, you might be thinking, who cares? Most people opening up Kalshi or Polymarket are happy to acknowledge what the regulators aren't. This is just gambling. Nobody goes into it actually expecting to make money, right? Well, this should be true. But the underhanded way that money is being extracted out of these markets, separate from firms themselves, is going to make them even harder to regulate, and even more lucrative to push onto as many customers as possible. I hope in whatever way it can, this little video helps to expose the way that this industry is really cashing in on desperate people. Now, if you want to see how bad this could all really get if we let it go on for long enough, go and watch this video next to see how Australia became the gambling capital of the world. I want to end this video by saying thanks to all of you for supporting my team and I this year by watching our videos. We will see you in 2026 to keep on learning how money works.